Okay. The objectives of this corporate governance chapter are: one, what is defined, what is meant by corporate governance. And if you take that word governance and take that to mean and equate to government, and government to equate to rules, what is ruling? What are those systems in place that we put in place to control the environment in which we operate? It give you a clue as to what governance really is. Okay, and then we're going to also describe and explain the scope of corporate governance using the OECD and the Icgn networks frameworks. So definitely you need to know those issues under those two frameworks, and one has 5, one has 4, and which comes under which. So what is the OECD saying about corporate governance? What is the Icgn saying about corporate governance? And what are those things that come into play with corporate governance? You need to know that. And then when you look at the different stakeholder groups relevant to modern business organizations, why is corporate governance so important? I had, whenever I have bad customer service, I always think of it as an unpleasant customer experience. And anytime there's an unpleasant customer experience, then that tells me that somebody somewhere needs some customer service training. I have a credit card that I've had for years. And I've never, just in January of this year, I noticed that the credit card added what they call life insurance on the credit card. And they charged me for October, November, and December. And then it continued from January, February, March. When I first saw it in January, I called the customer service representative and I said, listen, there's something amiss. I never applied for the credit life or the credit health insurance and whatever have you. She said, fine, it's happening to a lot of our customers and we've been trying to clear it up. I said, she said, but I'll take your name and number, Okay. February went. And so knowing that, I always have on my card what I could pay within 30 days. It was a $350 balance on the credit card, which I paid off. And I'm querying this money, which amounted to $18. And I'm writing and emailing to a couple of people. And then today I read online and I see, because I didn't pay the $18, they charged me $39 for late fee. So I call the number on the back of the card and I get this voice that is telling me that comes with when you sign up for the card, you sign up for credit. I said, I mean, for the life insurance and the health insurance, and how important insurance is and critical insurance care and all the rest of it. And I said, listen, I work for an insurance company. I've been 43 years in the insurance industry. I understand fully what the insurance is all about. My question is it mandatory? And if it was mandatory in January, why was I charged August, September, October, November, and December? Should not someone have said to me, when your card is renewed in January, it is going to be automatically being charging XYZ. And no, but I said, listen, let me talk to somebody else. Is your supervisor around? Is there somebody in management I can speak with? So they finally gave me somebody else. And at the end of the day, the guy, after I insisted, the guy said, so you don't want the insurance? I said, no, I don't. Okay, we'll take it off and it'll take 5 days to take it off. I said, so what about the August, September, October, November, and the $39 that you charged me that I was already querying and I was already saying that I didn't want, and I have emails going back and forth to say I didn't want it. You go, oh, we're just taking it off now in March, so everything before now. And I thought to myself, after hanging up on the phone, and it's like, you know what, okay. Could this be a concern of the financial institution to get monies into the institution by tacking on the $2, the $4, the $3 to every credit card holders that they do have? And only those ones who are persistent like me, they would say, okay, you don't want it, we'll take it off. Because if it was mandatory, then it should have been mandatory and said to me mandatory only from January when the new card was issued. And if I had the card for over 5 years and never subscribed to any life insurance, who made the decision that in January it was going to be tacked on? And if this is a international brand and it's done over all of their credit card holders, can you imagine the amount of money that they would have made on the ignorance of the card holders?
Tamiko, your hand was before me.
And the question is it ethical? Is it legal? Is it, and only because I was persistent that it finally came down to, and I'm like, listen, that doesn't make any sense. Listen, and I was like, I was gonna ask the supervisor manager, is there anybody else I could talk to? And he said, so you saying you don't want it then? And I'm like, what the hell? What I've been saying for the last 19 minutes, y'all had me listening to this music while you go and get somebody else and come back to me and explain to me all over again that it's for credit life and what credit life is all about and whatever. I started off saying, I do not want it. I didn't apply for it. And I didn't appreciate it being added without my knowledge. That was the first sentence I gave you. So was it really ignorance? Was it a plan? What happens to Sue, Drew, and Mary Lou who don't have the fortitude to fight the system?
I think, sorry to interrupt, Ms. Frazier.
No, go ahead.
I think we should be mindful of the fact that I know this is, you call a West Indies country. I know that, okay? So this reminds me of the Wells Fargo where people was having stuff added onto their accounts and they were getting charged these fees and so forth, and they were unaware of what is happening with their own accounts. This was done intentionally. And I think we're talking about tens of millions of dollars they would have made by the end of the year with all of their card holders, and nobody was thinking about $3 a month. That's a considerable amount of money. We would look at it and say $36 at the end of the year. Multiply that by millions of customers, and you talk about a significant amount of revenue. It was definitely unethical. And I would think even bordering on illegal in breach of some regulatory standard, whoever is the regulator dealing with that, like us with central bank, if it was something done. And I don't think that, could I go as far as saying, I don't know what bank it is, what institution it is, but could it be that they didn't educate their staff to expect payments to be calling? But then when you call, you traditionally get another country. If it's one of those institutions.
Well, to me, if it was mandatory, then it shouldn't have gone to the place where the last sentence was, okay, so you don't want it then. And I said, no, okay, we'll take it off. And it should be taken off within 5 days. It took me 3 months to tell you the same thing that you can do it now in 5 days. Why did it need an unpleasant customer experience for you to do something right for the customer? And you bundle it up in, oh, there's been a misunderstanding, or it was always there. And it started off with $3, but at one point it was a $14 pork. So it isn't it wasn't even and that's what threw me to something was amiss. It was not a set fee coming out every month. And he tried to explain it to me that the fee was based on what the balance was at the end of the month. So it fluctuated according to the balance on the card itself. So you know my scissors was having a wonderful time, right? The question comes up in an environment like that. Who's in control? Who's doing what? And what are they saying to their employees that service or are the customer-facing employees to make sure that whatever change is happening in the organization is communicated in sufficient time for the customer's expectation to not be horrific or an unpleasant one. And that's what all of these things are supposed to be in place for, that you have a system of how things are run, and there's people on the wall who can execute and explain what that is all about. Any questions? Concerns? I had a very fun-filled day, and it didn't end there. As I go, we'll have another experience. On page 8, but it talks about the introduction to corporate governance. The main thing there is how companies should be managed and how should their leaders behave. And there are some behaviors that are bordering unethical, immoral, but may not be illegal. And then there are some behaviors that are definitely illegal. And as your customer and your consumers, you need to be able to read the fine print and know your rights. And so there is a very good, and they gave us some high profile scandals that occurred over the years. The Guinness trader dealing scandal, the collapse of BCCI, the nationalization of the Northern Rock in the UK. Everybody knows Enron and WorldCom in the United States. And there was the milk Camelot in Italy. They mentioned those things. There's always plenty of scandals going on. And it's amazing how some companies create shell companies only to have money filter through, and there is no physical presence. And so now you are getting laws as it relates to who are the beneficial owners of these organizations that exist. You have to be able to identify and do self-certification and knowing your customer. I'm not only having to know Kendrick. I'm going to have to know KM Holdings Limited and who are the shareholders of that and who all have an equity stake in that. And one of the things that as a MLRO, a money laundering reporting officer, or somebody involved in compliance, you have to have a keen eye for when things appear too close to the margin, that you got to look deeper. Give an example. In the insurance industry, we have a situation where if you want $100,000 worth of life cover, you have to do this type of medical requirements. If you want $200,000 of life cover, you would need to do that amount of medical requirements. And then somebody applies for $99,000 worth of life cover. That should raise a red flag. Because anyone who thinking 99,000 would have applied for 100. So that person is deliberately not going to the 100,000 because he has some things to hide. if in the banking scenario, you say anything over $10,000, I need explanation. And a customer come in and bring $3,000 today, $3,000 the following day, $3,000 the third day. That should raise a red flag. Nobody wants to go into a bank, especially when you're standing online 3 days in a row. That person is operating under the radar and wanting to be under the 10,000 radar when they have to give an explanation. And that's why when you open up your accounts, the banks are now asking the volume that you anticipate will be coming through this entity in a given thing. Because if you say, well, about 10,000 or maybe 6,000, and I'm a business person and I do so and so, and suddenly they see 20,000, a check for $20,000, someone's going to be calling you to ask a question. And at first I was like, it was annoying, but now I'm understanding the need for it. And because you have unscrupulous people out there who want to fly underneath the radar. And if somebody, particularly those cash intense companies, entertainment, construction, what else? Hairdressers and people who say, you can't count how many people come into their store and they bring in cash, restaurants, food places, you know. And so there's nobody, I mean, you could write up enough receipts to say, we sold 6 fish dinner and 12 this and 12 that and 12 and so forth, and a couple of drinks. So we know that's where $20 came in and 20,000 came in or whatever. Or we had a concert and this is the prize XYZ. If you were not there to look at that concert and see that you only had 5 people in the room or 5 people attending, it doesn't add up to $20,000. It's difficult to say that didn't happen. And so people at the gate, like some of you are, will have to really be very astute with information. And so looking at what the definition of corporate governance, just in the middle of page 8, it says, corporate governance is concerned with how organizations, or rather those who manage organizations, behave. And we're talking about the management and the owners. And now, not only the managers and the owners, but their immediate family members as well. Because of what we've seen in the marketplace in our country or around the world is that wives and children and stepchildren and uncles and aunts, money is filtered into operations for them. So by a way to hide the true source of those of any funds. And so there is a simple definition, and then there is an OECD definition, which is a little bit more complex. We have to look at the agency theory and the importance that stakeholders have and the concern of management, and especially when you have situations where family members are major shareholders. And organizations ask for shareholders, persons holding more than 25%. So you see a 10 over here for Sue, who is the son, and a 15% for Mary, who's the daughter, and then another 10% of, so you stay under 25% radar, but in a one family, it's adding up to about 45 to 50, even 60%, okay? We have to look beneath the surface in order to see sometimes that this is a concern and an ethical dilemma that should be dealt with. So, and the Cadbury report had a definition: the system through which organizations are directed and controlled. The OECD had a more extensive definition: a set of relationships between a company's directors, its shareholders, and other stakeholders. It also provides the structure to which the objectives of the company are set, and the meaning of it, and the means of achieving those objectives and monitoring performances are determined. So it talks about a set of relationships between the owners and those stakeholders. Those stakeholders are the company's directors, its shareholders, and those people that are involved. And it actually says, okay, now that we have this company, what is the structure and what is the objective of this company? And how are we going to achieve these objectives and performances? And what rules are in place in order to make those happen? And so the scope of corporate governance, and these are elements which should be included: management of risk and operating sound systems of internal controls. Internal controls is very important. We're going to see that some more as we go into the next chapters coming up. Enhancement of performance by good management and stewardship within the best practice guidelines. And best practices does exist. We actually have persons who have written plenty of reports as to what the best practices are. And we've seen a lot of regional conversations with regulators. And so they're talking about what should be happening in the Caribbean region, for example, and what should be happening with their corresponding banks, and how that translates to what we should be doing in the Bahamas. Establishing a framework of good corporate governance so that the strategies can be pursued ethically and effectively with appropriate safeguard against misuse of the organization's resources. Definitely, growth should also be looked at, because if you're a traditional organization would grow at a rate of 15 or 20% per annum, and you see this company, new upstart, and their growth within 1 year is 50% or 75%, that should raise a red flag. And somebody who is regulating that industry in which that company operates should be looking to see why are they doing better than the norm. And it is dramatically better than the norm. What are those things that they are doing? And sometimes it could be legitimate. Some organizations have gone and some organizations have embraced digital transformation. And so they've cut expenses and increased sales. And so you might have a jump in salary, a jump in revenue. And having said that, once you analyze the situation and you find that that's the case, then you can now sign off. But you should ask the question. Then being able to attract new investment and retain confidence of existing investment. What are organizations doing? How are they presenting the financials to attract new businesses? I've seen people in the real estate business, they temporarily go in and dress up the house and whatever have you to say, this is how your house is going to look. They entice you to do X, Y, Z, and so forth. And the minute you either sell or don't buy that program, everything goes up again. And then you find that the plumbing needs to be repaired. Some of the hidden stuff comes out of the woodwork, almost like pulling up a floorboard, and all of a sudden there's so much stuff that is a negative impact to the pending sale as opposed to positive. So all of those things come out. Accountability of stakeholders, who is accountable to whom, and what systems are in place to make sure there's an audit trail on what should be happening. What is the confidence of the regulators and the markets in which they operate? Kendrick did a beautiful presentation of the whole governmental operations in this one particular organization in Malaysia, with the Prime Minister involved and his cohort. And so what is the confidence of the regulators in that environment? Who is sitting on the control button of the organization? So now we look at the OECD and Organization for Economic Cooperation and Development. It's headquartered in Paris. When I last checked, it had about 37 member countries. And the areas of coverage under the OECD framework, notice this, they say there are 5 that are critical in its principles of corporate governance. And the 5 are the rights of shareholders, equitable treatment of shareholders, stakeholders, which can include shareholders, but everybody else, and disclosure and transparency on the board of directors. Okay, those would be the 5 that you would need to know. And the role of those 5 you would need to know. And so let's start with the rights of shareholders. The arrangement that the organization has in place should protect shareholders and facilitate their rights in the company. Limited companies are morally obligated to generate investment returns for the risk capital put up by their shareholders. So their objective is to increase value, but it should not be to increase value at whatever cost. And it should not be increased value doing unethical, illegal things. And most countries have regulators and people in place to deal with issues of ethics. And most of it is the impact to the consumer or the general public. And if that's a negative one, what are the consequences of this behavior of this organization is usually what comes into play. And even though they cannot guarantee such return, that's the modus operandi that they want to increase shareholders' value. And so those who direct and control these organizations, like directors, they should be held accountable to shareholders in this respect. And so directors have what we call a fiduciary responsibility to the shareholders of an organization. And number 2 speaks to equitable treatment of shareholders. All shareholders should be treated equitably, which is fairly. It doesn't say equal. It says equitable, which is fair. And then there's a difference between equitable and fair and equal. Equal says everybody gets the exact same thing. Equitable means John might put in 10,000, Sue might put in 2,000, Mary might put in 1,000. So their treatment and in terms of what comes to them is fair based on their investment in the organization. And so equitable means fair as opposed to equal. And although it is quite proper that some majority shareholders should be able to exercise great influence in a company, this does not preclude fair treatment of the minorities and individuals and foreign shareholders. Some companies might say, because this group owns 51%, the whole AGM, or which is the annual general meeting, when they want to make decisions, the majority of the decisions have already been made by the voting body because they have the majority shares and they all agree that this should happen. So even if Kendrick does not want the company to go in that direction, but he is a minor shareholder, he should still be able to ask questions as it relates to that decision that's been made and make sure get his answer, his questions answered in that regard. But at the end of the day, the majority of the time, decisions are made by a mere majority. It'd be nice if you have motions where there's unanimous decisions, but it's not always the case. And it's understood. And if the shareholders are treated not fairly, they should have some redress. And there should be some appeal that they can go to. Now, stakeholders, as we mentioned before, is any person or entity that can influence the organization. Any person. It could be some customers depending on the volume that they actually purchase in the organization, for example. Any person or entity that can influence the organization and be influenced by it. The corporate governance framework should recognize the legal rights of stakeholders, such as suppliers, what rights they have under contract. The consumers have rights under common law, and employees have both a statutory right under employment legislation and common law rights. So the company should facilitate cooperation with all stakeholders in order to create wealth and employment and sustainable enterprises. And right now in the Bahamas, there's lots of talk going on about the minimum wage and also a decent country, a decent work country, or decent country work environment, sponsored by the ILO of the United Nations, and making sure that employers are treating employees very fair in their dealings with them from day to day. Disclosure and transparency. That word transparency is thrown around loosely in some circles, but organizations should make relevant and timely disclosures on matters affecting financial performance. And those financial performance should not be manipulated, overstated, non-disclosed, so that the financials could look good. Some persons might have in their financials, for example, the cost of replacement of items, which they've had for some years and would have depreciated, and they've never taken in consideration the now new depreciated cost. So when they're showing in their books as assets valued at 800,000, for example, that actual item is valued at about 300,000. So there's a $500,000 difference that could really impact what is seen inside the balance sheet and looked at in terms of a very profitable organization, when in fact it is not. It's a misstatement of value in the assets themselves. We also have some things that people do. If the year end closes, say December, and all of the filings happens 3 months between January to March the following year, they might actually defer some expenses beyond December, but they know they should have paid it. Okay. And I've also seen situations where organization or a organization might say, in the auditor's report, when the auditors went through the books, for example, let's say I owe Atia money, she's a supplier, and she sent me a bill to say her supplies cost $10,000. I, in my book, cut a check for her for $10,000. But the check itself is in my drawer. As far as the accountants are concerned, that bill has been paid. And when asked, well, I can't tell Atia when to deposit the money. I've sent her a check. We prepared a check. It's in our checkbook. It hasn't showed up in our statements yet, but that's outside my control. It's what the accountant or the CFO would say at that particular time. It's only when you call up Atia to find she never got the check. And so again, that's misrepresentation. And that could affect the financials. So those kinds of things are samplings of what a good auditor would do to make certain that the information that is present in front of him is actually present in front of him, and they is actually the true information. And anything other than that would be definitely illegal. Misstatement of any numbers to make the company look better than it actually is. So the company should not do anything, they must make relevant and timely disclosures on matters affecting financial performance, management, and ownership of the business. If you're thinking about, you've already made a decision to sack the CEO, that information should be disclosed once that's been done. because that will affect the person's, the external body stakeholders' view of the organization, especially if it has been a situation where it seems as if you keep changing CEOs. You've had 4 in the space of 2 years or so. That signals something is wrong. And good investigators would then say, wait a minute, I see a red flag, or I smell a rat, okay? Because that speaks to continuity, that speaks to corporate governance. It could be person are leaving because the board is trying to run the day-to-day operation around the CEO and not necessarily allowing the CEO to do his job and run a day-to-day operation and report to the board as specified in their document of how they propose to operate. So it is now generally accepted that public limited companies in particular should consider proactively not only their duty to provide financials and other information that is mandatory under the law, but also other matters that are material to the future of the business and the well-being of stakeholders. So if you're going in a new direction, you're going to look at a new product line, pharmaceutical companies looking at new research and development, how much money planning on spending on research and development, those kinds of things should be disclosed. Disclosure and transparency is definitely very important. And lastly, under the OECD is the board of directors. The board of directors is responsible for setting the direction of the company and monitoring the management of the company so that it can achieve the objectives that's set out. The corporate governance framework should be what is holding up the board, and the board is accountable to the company and its members. And so when persons are placed on boards, they should understand their responsibility to that board, and they should speak out if there is things happening at the board level that is detrimental to the organization. And in some cases, they call them the whistleblower. But otherwise, they could be held personally liable for not letting the record show that it was not a unanimous decision. They had their reservations about the direction that the company is going in. And once they register it kind of lets them off the hook. But to sit silent and not say anything when there's blatant disregard for any rules and regulations that the organization has put in place, or what they call good corporate governance, then it's to the detriment of that board member and his fiduciary responsibility to the shareholders and the members. And always be very wary of persons who hold large shareholdings in an organization, because sometimes they take that to mean that they can run the organization from their seat on the board, when ordinarily every board member has a vote on what needs to happen. And the bigger the board, sometimes the more challenges you have. A lot of companies like to have an uneven board with the chair of that board casting the final vote. It can go either way depending on how the chairman goes. So a board of 5 or a board of 7 or a board of 9 is more usual than saying an even number, because it can be split right down the middle and then nothing happens because it's a 50-50 split. And then there must be more conversations to try and win somebody over so that there could be a majority. Any questions on the OECD? That's straightforward. You need to know those 5 areas that it covers and what it means and what it's saying about those 5 areas. If you want to, you can also do some research online of the OECD and the wider paper that's issued by them about other things that they're doing, but it's up to you. We are going to be limiting our exposure to what's in the book, and any testing that would happen would be as it's presented in the book itself. Okay, the International Corporate Governance Network, or ICGN, is a not-for-profit, non-profit company limited by guarantee under the laws of England and Wales. It has 4 primary purposes. The purpose of this network is to provide an investor-led network for the exchange of views and information about corporate governance issues internationally. It's to examine corporate governance principles and practices and to make sure that best practices are always existing. And then they to develop and encourage adherence to corporate governance standards and guidelines. And then to promote good corporate governance, good corporate control, good corporate systems that is being audited by several individuals as opposed to one individual. And again, like I'm remembering with Malaysia scenario that Kendrick spoke about, this one person kind of held 3 different roles in the whole scheme of things. And so that is never a good thing, never a good thing. The framework proposed by the ICGN has all the features included in the OECD framework, but then they use 4 categories of responsibilities. And the purpose of the framework is to provide practical guidance for board of directors of companies to enable them to operate efficiently and effectively, to actually use scarce capital resources very effectively, and to facilitate productive communication on matters relevant to corporate governance. The ICGN framework they mentioned is more detailed than the OECD and sets down some specific best practices that should be adopted by companies. And they have examples of them. The board of directors. The board should guide strategy, monitor performance, and effectiveness of governance. They should deal with succession issues. They should deal with remuneration policies, ensure the integrity and oversee disclosure. The board usually gets involved with the hiring of management and senior executives, maybe not so much your line staff, but definitely your managers and executives. The director should have the appropriate skill, knowledge, and experience to demonstrate independent judgment and fulfill their duties. For example, we have some boards where, for instance, it could be a board as relates to energy and environment, for example. And on that board, we have a person who's just barely over 18, finishing school, have no knowledge of how businesses work or energy or the environment. But because of my father might know somebody else's father, and this is a paying board where he gets money for sitting on the board, he sits on the board, or he's appointed to the board, or have no skills in relationship to that board, that would definitely be against the framework of the ICGN, because they should have the appropriate skills, knowledge, and experience to demonstrate independent judgment, to ask the right questions, to fulfill their duties. And it should not be just because you did something for me, that's my friend, that's my boy, I put him on the board. Most of the time, that's a bad board placement because the familiarity between the individuals is almost ended into groupthink, as opposed to somebody challenging and asking questions and finding out is how the proper research and monitoring and all that good stuff is involved. And so you should take anybody who's on a board to take their board appointment very seriously, and not just, it's just not an extension of their resume, but the fact that you have responsibilities as it relates to that particular board should be taken very seriously. And directors should present themselves for re-election at least every 3 years. There's a lot of board governance that says the person can only serve a maximum of X, Y, Z. And so, because they want to make sure that new ideas and new information is coming into the organization. And I've heard the majority of it between 2 to 3 years, and not necessarily longer. So if you have persons who sat on the same boards for 15, 20 years, at some point, it is almost as if they have stopped thinking and bringing new ideas and actually shut down, or they are leading the board in a particular area, because a lot of us, as we are new appointees to boards, we kind of fall in line with everything that's been done and said from the previous board members, if they are still on the board, and we kind of say, oh, they have some knowledge that we don't have. And so we go, yes, 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 as opposed to challenging and asking questions and doing research and wanting to see exactly what is happening. The board itself, the role should have the role of the chairman and CEO, and the role of the chairman, this is very important, the role of the chairman and the CEO should be segregated. So if this one person is chairman and CEO of the board, you got a potential problem. The board should establish audit, compensation, and nomination governance committees independent of the operation of the organization, and it should be looking at any of them closely linked to the owners, shareholders, and or anything else, because you would want to make sure that you get objectivity and not subjectivity and familiarity, actually leading the organization in a direction that is untoward where they want to go. And so the formal process for evaluating the performance of the board and its members, this should be in writing. There should be a formal process, a formal document that speaks to that. And so all board members should understand their role, understand their responsibility, and understand how they impact the overall governance control of that organization. The shareholders are owners, and the rights of the shareholders should be protected. They should be able to move resolutions that are advisory, or binding on the company. Major changes should not be made without prior shareholders' approval. Major changes. Institutional investors should be able to discharge their fiduciary duties to vote and should be able to consult with their management team. And shareholders should also have the right to take action in the event of inequitable treatment. That's the role of the shareholders in terms of best practice. Audit and accounts, because a lot of these things that are being done, they have financial implications. And so companies should aim to excel in the financial returns they achieve compared to relevant benchmarks. There should be full disclosure of ownership, voting rights, shareholders agreements, and any significant relationship, any major suppliers, any major vendors, who is using our product, why are they using our product, are there any collusion between management XYZ, is there anybody getting any kickback from placing the business with this organization, and where is the money going? If you follow the money trail, you normally find whomever is in place and whether or not they are operating with full disclosure and transparency. And there should be a relationship with external auditor, and it should be overseen by an audit committee. Okay, and any internal auditors is reporting directly to the board as opposed to some management team at the organization. Because if you think that you might end up losing your job because you report to the CEO, then you will not do as good a job or the due diligence of the committee itself. And then it speaks to ethics and stakeholders. The implement of code of ethics, they should be very clear and defined and implemented. The company should conduct activities in an economical, socially, and environmentally responsible manner. If you are producing anything, where's the waste going? Are you emitting any gases into the atmosphere? What is the environmental impact of your operation? Are you eroding any of the shorelines or the marine sea family or the fauna of that particular property? Especially when we live in a country, particularly in the Bahamas, where people come from near and far to take advantage of our natural resources, to see our natural resources. There's always been questions about any wastage being dumped into our seas. When they talk about the oil exploration, one of the concerns was what happens if there's an oil spill to our marine life and whatever have you. Those kinds of things should actually be taken into consideration before the company gets up and running and doing whatever it is that they say they want to do. And the board should promote a climate of integrity. A lot of people start off with having integrity, but sometimes the stakes get so high or the person gets so enamored by the games that they're playing and the cards, the deck of cards that they're putting together. It's like that dominoes that start to fall. When one tips over, everything else extends. And so they get drunk with the power of playing in the big leagues and playing with a lot of the monies or playing with the people of, what's the word I want to use? The people of means and their lifestyle. And suddenly they want to take up golf, or they want to take up, they need a corporate jet, or they need the managers of cars, which suddenly before it was, we pay for gas allowance. But now we all have cars, all of our managers have cars that are leased or purchased for their use. Those kinds of things we would want to look at to see how that's impacting the organization. Implementation of procedures for monitoring related party transaction and any conflicts of interest. For example, who are we purchasing? Who are our major suppliers? Who are we purchasing our papers from? Are we getting it from the boss wife or some cousin, or are we spending a lot of money? Are we checking to see whether what's being offered is fair compared to the marketplace, or are we just cutting a check and sending it because there's a relationship that exists between some party and management or whatever have you? All those kinds of things should be taken into consideration. And that's what I talk about related party transactions. We're supposed to look at on who's making the decision on what happens. The board to be responsible for managing successful and productive relationship with stakeholders, and also policies towards stakeholders should be disclosed, and everybody should know what's involved. So openness and transparency, independence, honesty, responsibility, accountability, reputation, judgment, and integrity are some of the words that the qualities and the concepts that they expect to be as part of the corporate governance. And because different people have different explanation or different feelings towards corporate governance, a lot should be in writing, and there should be some document that anyone who is in question could actually refer to. On page 13, we have the case study of Enron. And I'm glad that none of you did that, Enron. So what I'm going to do, we have 1, 2, 3, 4, 5 individuals on board. We're going to look at the Enron case. And what I would like is 1, 2, 3, 4, 5. Yeah. We have under the case study on page 13, Kendrick, that paragraph that starts with the Enron Corporation was a energy company based in Houston. Can you look at that paragraph and tell me, and when we come back together, we say what were the facts in that first paragraph? Shanquell, the paragraph that starts with prior to the disaster, what are the facts? Tamiko, or Atia rather, that once the problem was uncovered, that is Atia, and Tamiko is the systematic false accounting, and then we'll wrap up on what happened in that particular case. So just so you can get some practice on identifying the facts, and I've assigned you individual paragraphs that you could look at. I give you, and you from what I've seen and heard, you guys are so good at identifying the facts. I don't think you need more than 10 minutes. So I'm going to put myself on mute for a short while, and then I'll come back. It's now 7:42 at 7. You probably don't need the 2 minutes. I say 5 minutes. Let's say what's that? 7. Give you 7:50. We'll come back together, and I just want you to say what are the facts in those paragraphs, so we can get a good appreciation of where this case went and what's happening. Okay, Kendrick, you leading us off?
Yes, ma'am. The facts of the case study, first chapter, not first chapter, but first paragraph. First paragraph, we're dealing with a company by the name of Enron that is an energy-based energy company that's based in Houston, Texas. They were also large producers of electricity, paper, and also went into the communication business, deployed about, I think it's 20,000 employees. In 2001, they filed for Chapter 11 bankruptcy. And they were also labeled with a systemic accounting fraud, which included their executives or their directors.
Great stuff. Great stuff.
Thank you.
Shanquelle?
Prior to their mishap, they were highly successful and reputable, being voted the most innovative company in America on numerous occasions. Their business model was integrated and diversified. This helped them to spread their risk outside of the energy industry. They not only marketed the energy, but they were also the facilitators and conductors of the products, which would have been the plants and the pipelines.
That's it?
Yes.
What about the fact that they move into telecommunications and e-commerce?
Well, I thought that was kind of caught up in the point about being diversified and spreading their risk outside of energy. So I didn't explicitly state it because I thought that covered it.
Fair enough, fair enough. Because it started off with energy and now they are in pipelines and plants and telecommunication and e-commerce and trading derivatives. So obviously, all these other areas meant financing and money is going to them. And so it was the beginning of the web that was being weaved. Yeah. Okay, I think Atia is next. Once the problem was uncovered, that paragraph.
Sorry. Okay, once all of that was uncovered, the financial statements were completely misleading. They recorded assets that were more in value and in some cases non-existent. They had placed debts and other obligations with offshore entities. So thereby not consolidating them in the group accounts. So we're basically off, and they were basically putting more on the books than they were actually making.
So more assets was actually added to the books and more debts was being transferred off the books. So it was looking better than it actually was. And so definitely manipulating of the accounts and the financials in that regard. Okay, and then finally, we have Tamiko.
Good evening. The systematic false accounting led to criminal investigation, an arrest and indictment of several senior figures in the company. Several directors paid significant sum of money to settle lawsuit against them. Jeffrey Skill was the former chief executive. He was sentenced to 24 years in prison for numerous charges, including fraud. And another senior executive died while awaiting trial.
Okay, and so that with all of that happening, it says that the N1 case was not confined to the company itself. There were questions were raised about the failure of Arthur Anderson, the external auditors of the company, the failure to identify the inconsistencies in the accounts. And this led to the subsequent breakup and dissolution of the accounting firm. But it went to a smaller group as well. So it exists. And the successor of the N1 company, N1 Creditors Recovery Corporation, survived today with less than 500 personnel. So you started off with a giant of 20,000 employees and you got down to 500. The scandal was well known, and the results it led to a reprisal of standards of corporate governance in the United States. And it actually was the prime mover for the introduction of the Sarbanes-Oxley Act in the US, which established a public oversight board and greatly reinforced the laws on senior executives' accountability, and it influenced the stock exchanges of many countries and accelerated the creation of codes of practice to which all listed companies in the US and UK are now expected to adhere. So that one was just so much involved and so much happening that it actually changed the course of a lot of things happening in that regard. Now, one of the things that how the scandal could have been avoided if there's proper corporate governance in place, and as each one of these entities were created or divisions were created, proper due diligence would have been in place to make sure that the monies are going where they said it's going to be going, and they were doing separate accounting for each one of those divisions, possibly if it wasn't in the same house, and more checks and balances would have been in place. And the fact that the executives had so much control was what led to this happening. And they all benefited by having the big high bonuses that were naturally paid when they were showing that they were more profitable than they actually were. Okay. Let's try this again with the Robert Maxwell case on page 15. We're going to start the other way around now. Tamiko is going to be with the Robert Maxwell, the very first paragraph. Atia, can you take Maxwell's success, which is that one sentence, and add that to the third paragraph? And then Shanquel, can you take the paragraph right underneath that, which will be as it happened, Maxwell borrowed. And let's get Kendrick to do in 1991. And then I will go back around and have Tamiko. Maxwell died. Atia will finish it off for us. Okay, everyone has that?
Yes.
Okay. You will get 5 minutes also. So the agency theory, the main thing about the agency theory is the agent finds the principal. And as companies get bigger with more shareholders and more resources at their disposal, there's a greater degree of separation between those who own the business and those who manage the business. Okay, and the owners are the shareholders. The shareholders don't have to be directors. They can appoint independent directors. But there are some directors who are shareholders. If the managers act inappropriately, usually they will only be damaging, they will not only be damaging themselves, and if they inflict harm on others, it's usually relatively easy to apportion blame. And so larger companies are very keen to make sure that their executives, their key executives, behave in such a way that it does not bring any reputational damage to the organization. And it's good when shareholders do not know those who manage the business. Because sometimes they could influence persons if they if they know. And when they are at the annual general meeting is when a lot of things get brought up and the status of the company and how the company is operating and fair at that particular time actually comes to light. And so the agent relationship can cause issues if there's a breach of trust by management. Intentional acts such as misrepresentation or fraud, omissions and mistakes caused by human error or lack of due diligence, neglect of their duties. Some people on the board don't show up to board meetings, and a lot of things get done and said and transpire without their knowledge. But as a board member, they're still held accountable because there's minutes of meetings and there's actually they're expected to reach out to make sure that they keep up to date. And then they talk about incompetence. The board members should have the, like I said before, the knowledge, the expertise, and the skill to operate at that on that board. And in some cases, when there's rapidly changing environment, how well they manage and help. And sometimes too, people are brought to the board because of their specific expertise. And at board level, there is no minimum or maximum age level. You know, like how employees got to be normal retirement age of 65. At board level, there's usually not a age situation. Once a person is functioning with all capacity and can bring value to that organization, then they are normally put on the board and can be a very effective board member. Let's jump down to officers on the bottom of page 18. The law sets out to protect the interests of the company and its members by defining the rights and establishing obligations that must be fulfilled by the officers. The term officer is a generic one that can be applied to directors, the secretary, and some other senior management. They are the officers, and they are accountable in law for certain actions specified in legislation. And it's common law. In common law, they may be accountable under the principle established in decided cases. And when you have where cases have been decided in the past, they normally call them precedents. And once the precedent has been set, you can use those terms for as a rule to how this particular case should be worked out. And when you hear the company say, for instance, the president or CEO, the secretary of the board, the treasurer, those people, they are the actual officers of the company. And generally speaking, all officers are on the board, but not all directors are officers. Does that make sense? The treasurer sits on the board, the CFO, treasurer, financial controller, the secretary of the board, the president, CEO, they sit on the board, but you might have other directors who don't have a title as such. And so they're not officers, but they are directors, and they help to direct the company and the behavior of the company. So you must be very clear that there's a difference between officers and directors. And we have the non-executive director. The non-executive director is a director who does not work in the day-to-day management of the operation. So it's an outsider. And there are some rules that say there should be a certain number of outsiders on the board so that it brings objectivity to the organization as opposed to anything else. The directors of a company are the individuals entrusted with the running of the business on behalf of its owners. The directors of a company are the individuals entrusted with the running of the business on behalf of its owners. And so the board sit at the top of the management structure, and the owners of the business are the members or shareholders. So the shareholders, someone can have a share in an organization or a large share in an organization, but not be on the board because they've entrusted the running of the organization to the board. And the owners of an organization cannot always take the routine decision that affect its future. And this is nearly always true of large public limited companies. And so there may be many shareholders who are quite remote from the running of the business. They only know they have some shares. And for instance, we have persons who have shares now in our port development company, but they don't get into the day-to-day running of it because the shares are so minimal. And they have the board of directors whose role it is to manage and maintain the business and to make sure that everything is in order. It talks about in the UK, and we follow very closely what happens in the UK, all the pump and pageantry that we go to, and the Privy Council is the head of our legal system in the UK. So we follow a lot of the common law situation and statutory law as in the UK, being a Commonwealth country as well. The directors of a company usually have a general power of management set out in the Articles of Association, affording them a large degree of discretion in decision-making. And this effectively means that any decision taken by the directors within their normal day-to-day operational authority cannot be subsequently set aside by the shareholders, even if their decision does harm to the shareholders. So collectively, we make a decision, they might go the other way, but we cannot be held accountable because it was made with information and in the best interest of the shareholders, but things just happen. And although the shareholders can do many things, including removing one or even all of the directors, they cannot reverse the decision of the directors that affects third parties. So keep that in mind. And they talk about the different types of directors, and midway down, they say there are two main types of directors: executive directors and non-executive directors. Executive directors are full-time employees of the company and therefore have two relationships and two sets of duties. So they are employees as well as they are directors. Okay, non-executive directors are not employees of the company and not involved in the day-to-day running of the company. And that's the main difference between the two. But as directors, they have the same rights and duties and have the same voting powers at the board meetings, unless the Articles of Association state otherwise. Okay, so main distinction, one is an employee of the company, the others are not. And it does a board good if you have a combination of executive and non-executive directors on the board. Okay. And on the bottom of page 20, it says that the director's accountabilities and responsibilities are normally defined by up to 3 sources of control: statutory, common law, and here's that word again, fiduciary. The statutory duties arise under legislation, and these include convening meetings in accordance with the law and the demands of members, placing the financial accounts before the members, declaring their own personal details and interests by completing a statutory return to the company registry, and compliance with all other aspects of the law for which they are accountable. And the law requires them to be fit and proper persons. Yes, fit and proper meaning they cannot be in a scandalous relationship or anything that could negatively impact the reputation of the organization. And they must have the expertise in order to perform at that particular level. And for regulated financial service providers, the directors and some other officers must be approved person, meaning having the proper certification to be on the board itself. Directors must maintain the members' approval prior to entering any substantial property interest. And then the common law requires directors to discharge their responsibilities with due care and attention and skill. Because directors can be liable for civil wrong. They are also directly accountable to the company in common law, and as such can be sued by the company, the directors. Okay. And they give you a case of the Guinness PLC when there was action was taken against Ernest Sanders, his former CEO. And any employees in the organization who understand the implied terms of their contracts have a duty to act with due care and skill. So at the bottom of 21, we talk about fiduciary duties as it relates to directors. And directors' duty of trust to the company can be in these areas. They must act in a good manner in the best interest of the company by exercising their power for a proper purpose by the constitutional documents of the company and mandates conferred by the board. There must be avoidance of conflict of interest between their duties as directors and their personal interests. And one of the ways of avoiding conflict of interest is to making the proper disclosure where there might be some interest. And they must maintain their duty of confidentiality, not making any secret profit declaration or any vested interest, and avoiding inappropriate use of company property. So a fiduciary is a person who is entrusted with assets belonging to others. We mentioned that before because it came up before in the first book. The fiduciary responsibility is a moral one arising from the trust placed in an individual. So John has decided to put some funds aside for the benefit of Sue, and John has entrusted Tamiko to maintain and take care of their fund until Sue needs it. So there's a fiduciary responsibility that Tamiko has to Sue because she's been entrusted with property. It could be land, it could be monies, it could be the benefits of a life insurance policy to look after it in care for Sue. And that's how that fiduciary responsibility comes about. And so it's a trust placed in that individual for the protection of some property for the benefit of somebody else. Okay. And they talk about when the company is formed, it might have promoters who are charged with the responsibility of taking steps to form the company and set it going. The person who's doing that or the promoters cannot have a contractual or agency relationship with the company as it does not exist until incorporation. So they just getting paid for the benefit of as a consultant, but they could not benefit from anything in the company until the company is actually formed and set up, because that's the whole idea that they were hired. The directors exercise their powers on behalf of the company and take these and make decisions entrusted to them by the owners of the company. And when a deposit institution, it permits a young person to make transaction without the supervision of an adult, the institution may be regarded as having a fiduciary responsibility in respect of the interest of the young person. I remember we had a conversation before when the young person wanted to get $1,000 from the bank, and it was said that he was allowed to get reasonable funds, but there was question as to what he might be doing with the funds based on past experience with friends, where someone saw him in a drunken state. The bank is then acting to protect the account as a fiduciary responsibility exists between the bank and the young person as account holder. And that they give as an example. And so the shareholders actually have the directors as their agent. The directors is carrying out a job for their agent. And that's where the agency relationship exists. And agency costs arise from attempts to monitor the actions of agents. And they may be considered in terms of money or resources consumed or time taken to actually monitor them. And so you have to have something in place to check to make sure that the agents are doing what they say they're supposed to be doing. Now, on page 23, it mentions that one of the key issues in corporate governance is to establish ways in which an organization can align the interests of the enterprise with those of people who manage it. So you're actually coordinating all of this. And alignment of interest is sometimes referred to as a goal congruence. It seeks to ensure, note this now, put a marker here. It seeks to ensure that by pursuing the interests of the company as defined in the mission, objectives, and strategic plan, the interests of the agents may also be achieved, because we all should be working together in one goal. And there are various ways in which companies can do this, including profit-related pay, permitting managers to purchase shares in the company, and introducing executive share option plans. So what they're saying is to make sure this happens and is maintained, sometimes they can use incentives for their directors and officers as they be a part of the company. So you give them an incentive to take good care of the organization. And sometimes these incentives could be a catalyst for why people would continue to behave badly. Because I think in one of the cases that you had, the officers and directors of the company was getting paid big bonuses despite all the things was going on. And I'm really intrigued by a lot of the banking scandals that has gone on over the last couple of years. And I've also noticed that, and I mentioned this before, that some particular bank probably had a scandal at least 3 times in 3 different years. And these scandals are not in the thousands. The majority of them are in the high millions, and some are even in the billions. And so it is almost as if the organization has a culture of misappropriation of funds or misleading and not representing appropriately financial documentation for the benefit of the officers and directors and the big bonuses to make the company look and appear more profitable than it actually is. In the middle of page 24, it speaks to the stakeholders in corporate governance. The stakeholder approach suggests that those who are affected by and can influence the organization, as the stakeholders, should be taken into account when formulating strategies and policies. On the concept of stakeholders, which we talked about earlier, I explained that they may be categorized as internal, connected, and external. Connected would be like your third-party service providers to that organization. External could be your customers and your community at large. And as any organization must take account of those who can affect its performance and who can be affected by its action, an analysis of stakeholders is the natural starting point for any consideration of corporate governance. Okay. I will want to jump now to, but I leave those cases for you to read. I think you have a very good grasp of managing and handling cases. I want to jump to page 30. On page 30, we have the issues, the contemporary issues in corporate governance. So all we're talking about is control and how and who controls and how they should operate within their controls and the behaviors that must be displayed by those persons in control, knowing that they are responsible legally, statutorily. They could be responsible from a common law perspective, and they could be responsible from a fiduciary responsibility. And so they should take those responsibilities very seriously. And before being appointed to any board, they should understand the operation and the role of those persons, their specific role as board members to that organization. On page 20, it gives on 30 and 31, it actually gives us 9 issues in corporate governance. And it's best that you know how to deal with these issues, or to understand and recognize whether or not these issues are in play and the company is being operated effectively. The first one, they talk about the duties of directors. And they say that there has been an increased focus on the fiduciary duties of directors. And so a lot of the stock exchange and things related to stock exchanges has caused issues over the years. And so as a result, some countries have strengthened their legislation on accountability of directors. And they have the Companies Act, which codifies some of the existing duties of directors that are previously left to common law and equity law. In terms of now they're saying statutory, there's laws on the books that speaks to how directors should behave. And they talk about board composition and committees. Several reports have stressed the need to ensure that excessive power is not vested in a single individual or group of individuals. And of particular importance here are the findings of the Higgs report and the recommendations of the Combined Code on Corporate Governance, which says that increasingly codes of practice are focusing on the important role of non-executive directors and their oversight role. Non-executive directors does not mean that you don't participate at the director's level. It only means that you don't be in the day-to-day management of the company. But when you come to the board, when you come to board meetings, you are equal to any other director, and you should have the information readily available to you to assist with any decision-making that needs to happen. Directors, how are they compensated or remunerated for their participation? You have some boards that have what they call fat cat salaries and reward packages for their directors. They might have a lot of trips involved. If the trips are rewards for participation, that's one thing. But the trips could also be a part of the daily operation of people, how they attract business and how whether they have the international expertise and contacts. When I was looking at this, I was thinking about all of the movements of corporate Bahamas and government to Dubai for the Dubai 2020. And it was with a view to meet and expose the Bahamas to entities and businesses, and to have that dialogue with businesses to encourage businesses to take advantage of what the Bahamas have to offer. And so a lot of things is happening in that space where some people are alleging that the trip is more fanfare, but when you want to do business in certain jurisdiction, then you have to make sure that the players at the table understand doing business in the Bahamas. And some things can vary from country to country. And so definitely those things might be a part and parcel of operation. Directors, we have financial reporting and audit. This trends towards greater transparency and risk containment or reduction. External auditors have come under greater scrutiny due to the shortcomings exposed by BCCI, Enron, and Pamela. And then in the US, they mentioned this Sarbanes-Oxley Act again, where they talk about very rigorous legal controls in respect of audit. And in watching some of those issues on Netflix, it actually, some of those cases went before Congress. And so that's the extent of how much things has evolved to make sure that a lot of things are in control. And it appears as if the severity of the penalties and the controls that are expected to be in place is directly related to the impact on the general public. And so I note with interest cases related to pension situations and having pensions readily available for the employees when they retire, affecting their 401k or their pension plan. And I also noticed with interest the healthcare scandals in terms of pharmaceuticals and the fact that people are not responding to the potential harm being done to individuals by lack of or not being able to afford pharmaceuticals that they need for life itself. And without any new research or development, how high some of the much needed drug has gone in terms of pricing and cost from when they first started out. And a lot of physicians do not allow you or tell you that there might be generic drugs that can be used, and you don't have to use the label ones or the highly publicized one, because the cost in some cases could be as much as thousands of dollars differences. And I always have a soft spot for when individuals are at their worst. They're already sick and they're already concerned about issues related to sickness. People take advantage of their terror and their fear and make them spend exorbitant amount of money just because. And they traffic in fear, you know, and you could see the role that physicians play, the role that pharmacies play, the role that insurance companies play. And it's amazing that people say to clients and patients, oh, don't worry, the insurance company is going to pick this up, so I'll charge you X, and the insurance company is going to pay. But at the end of the day, even if the insurance companies pay, when them claims go up to a certain place, the insurance company is going to transfer those increases back to the consumer by way of increased premiums. And so the customer ends up paying in the end anyway. And so the benefit is that all service providers can operate in together to manage the care of the individual at a cost that's effective for the persons involved. And so my heart goes out to individuals who find themselves in that category with a very serious illness and having to borrow money or have medical, have cookouts and whatever else, just to meet the difference that insurance does not pay. And primary care is not where the issues are. The issues are normally where there's a catastrophic scenario that needs to be addressed. Because anybody can find $100 or $200 or even $1,000, but it's when your care is costing you in the thousands, and even the insurance company decides that they're going to pay 80-20. 20% that is borne by that individual could be a lot of money. And so you don't want anybody in that environment creating fraudulent intent and hiking up prices and almost penalizing the individuals for being sick. Is what I say. So even if, like with me in the insurance industry, my heart goes out to those individuals who find themselves in that position. And it's a tragedy. They also talk about risk management and control. There's an increasing focus on board responsibility for the effective risk management policies and strategies. And there's some risks that should be anticipated and plans put in place to mitigate if you can change the number of occurrence, you could possibly change the severity of it. Like a situation like Dorian could not have been anticipated, could not have been mitigated. The good thing that some persons did was transfer the cost to insurance companies. And I could tell you, collectively, the insurance companies in the Bahamas paid out near to $2 billion, and that's billion with a B, $2 billion worth of claims for Abaco and Grand Bahama and the effects of Dorian. And so had those entities not had any insurance, it's going to be a sad day in the lives of many. It was a sad day in the life of Bahamas as a whole, but it would have been worse. And so when I hear people say, oh, insurance is a bunch of rip-offs, sometimes I smile because I know the numbers. And I'm sure a lot of, some persons even took the money and said, because in Abaco, they had some second homeowners. And they're like, we're not going to rebuild. We're just going to take the money and run and we stay Midwest and where we don't have hurricanes and whatever else. But they have their own other share of issues. And some people are taking the position that they want to rebuild, but now they will not do so close to the shorelines. But like I said before, something like that, which actually appeared to have been a tornado within the hurricane, could not have been anticipated, and we have not seen anything like it. The pandemic, we've not seen it in my lifetime, and I haven't seen anything like it. I've read about it. I've read about pandemics in the past, but few and far between. And so this again is going to have a negative impact on what is happening or what has happened. And in some ways, for example, the National Insurance Board was never intended to respond to a pandemic. And so there's issues that's going to be coming out of that, I think, for years to come. And we don't know what the impact of the present war situation between Russia and the Ukraine and the effects that would have to doing business in the future and oil prices and all the things that we use oil for. And once there is a shrinkage anywhere, we as a small island nation who spend about $1 billion a year on food imports, just food alone, that could dramatically be affected. Our financial systems are going to be affected, and who knows what else, because we need the ships to come in order for us to enjoy the lifestyle that we have been accustomed to. So that is what a lot of the financial institutions are watching and businesses are watching as we speak. And if prices continue to trend up, they're going to be, as the economy is just starting to get back to what they call normalcy, we have another issue that we need to deal with. So people were talking about a double whammy, and we're hoping that it stays there. And that's between Dorian and the pandemic. We don't need a triple whammy and to go backwards to where we would have been 2 years ago, where people were lining up in front of the food stores and lockdown and looking for places to go and places to see. So I'm like everybody else, just watching to see what happens. Rights of shareholders, we talked about a lot tonight, and the contemporary report stressed the need to provide shareholders with material information that may affect their wealth in order that they may be more inclined to exercise their rights, their democratic rights, by attending and voting at general meetings. Some people sometimes think their holdings are so small that it don't really matter. They can't really change anything that's happening, but it's best to be made aware of what's happening than not. And they talk about the corporate social responsibility and environmental impacts and ethics. The environmental impact studies and assessments, increasing concern as the world becomes more aware of things, effects of business on the community and environment. And there's lots of talk about climate change and what that means. There's a lot of talk about renewable energy. Ethical behavior is a major area of focus, especially as unethical behavior attracts considerable publicity. And so I look with interest, and when I was reading this, and this one statement that came in this book on page 31, it says, the personal conduct of directors is a major issue in many countries. For example, directors of companies in the Russian Federation are subject to intense government and media scrutiny. I thought it was very interesting. The directors of company in the Russian Federation are subject to intense government and media scrutiny. And why that was the interest in me is the question of if the directors are subject to intense government scrutiny, what scrutiny is given to the government and what they can and cannot do. But that style of government lends itself to certain things that other styles don't. Public sector bodies, there's debate on corporate governance as extended to government and quasi-governmental organizations. So in our country, water and sewage, BC, those entities can be quasi-government, government involved. There's lots of scrutiny now for nonprofit bodies and certain regulatory filings and corporate documentation must be in place for nonprofits and foundations. There's lots of talk coming up on foundations and the right reporting of foundations. And that's primarily because a lot of things have been, a lot of entities that found themselves in a foundation mode. It was hard to find and see the source of their income and the source of their wealth, and under the guise of the terrorist financing and money laundering, more and more we want to find who are the beneficial owners of these foundations, what is their source of funding, what is their source of wealth. Those kinds of things are in the public space right now. And so that's some of the contemporary issues that we're dealing with. These kinds of quasi government agencies is of interest because it demonstrates the value for money to their stakeholders, and their stakeholders usually end up being the taxpayers. Healthcare services, we talk about the national health insurance, what does that mean? Public sector broadcasters, the ZNS, and any charities that are out there. We used to, there's been lots of talk about the Cancer Society and the Heart Ball and those kinds of things. Without those fundraising events during the pandemic, then the funding to those organizations are being dramatically affected. And so the benefit derived from those organizations would be impacted as well. And in those cases, performance cannot be measured by conventional indicators. Okay, hopefully, luckily, we didn't have that many persons who needed the benefit of their services and funding. But I have someone who tell me when she, in the midst of the pandemic in 20, close to the end of 2020, she was not even checking whether she was sick or well. She had just decided that COVID came to take everybody out. So she was not even paying some bills. So it depends on how you see some of these challenges and changes in the area. And lastly, regulation. The method of establishing good standards of corporate governance may be influenced by the views of government and their advisors. And then they put in a lot of legislation in order to make sure companies do what they're supposed to do. And there's lots of government new portals that came up within the last 2 or 3 years where you have to file all of this information somewhere, and they'll be under scrutiny by government officials and government regulatory bodies, and to make certain that all the corporate governance is in place and all the know your customers and compliance. Before the word compliance, before I would say 10 years ago, compliance was just like showing up to work. Now compliance has come as a whole legal body, and we have an association of compliance officers, and there's lots of lawyers represented in that space, because to be able to unravel a lot of the issues with the new legislation and new regulatory requirements, you really need someone paying attention and focusing on those issues. And so you've seen lots of regulations passed in the last 5 years or so as relates to corporate governance, anti-money laundering, and also terrorist financing. Okay, and so I suspect that you're going to see some more. And related to this is the extent to which organizations must disclose activities, and they want to know. Transparency is the key. We even have a new Beneficial Owners Act where you have to register who the beneficial owners of this organization is, and have documented on file copies of IDs and proof of address and those kinds of things. And so particularly we've had in this environment our first active stock exchange launch, and a lot of the issues that came out of the financial scandals in the past actually had impact or influence from the stock exchanges and those agreements through which these trade federations or code of statements of practices actually operate. And a lot of the companies trading is affected when the financials are being manipulated, and persons are actually buying shares to hike up the value of the organization from monies and bonuses gotten from the organization because of the value. And so there's a vested interest in people doing things that they probably should not have. I'm going to scan and send to you the words that's just behind this, because I do have it in my book, and that you could all have it. But like I said before, the list is very short. I'd also like to just say from my calendar, this is chapter 1 on the 17th. We should be going into the second course, the second chapter, which is chapter 3 for the 24th. That should be in your book. And the next Thursday, the next, which would be the 31st of March, we have chapter 4. And then the 7th will be chapter 5. Now, for my calendar, Good Friday is the 15th. We could decide to have the end of term on that Thursday before Good Friday, which is the 14th, or we could let you have the Easter holiday weekend for studies and have the end of term exam on the 21st. And I'm open to any suggestions that you might have in that regard. You don't have to answer now. You can go away and think about it, but that's the kind of time frame that I'm looking at, because in this new book, and the fact that the book stops off at 170 is not a problem per se. Let me just double check my book to be absolutely sure. So I don't want you all pulling your hair out and thinking you're going to miss something. Page. Let's see. Page 170 ends with I think you might need page 171, because what's on 170, evaluation of control systems, it actually, and I get that to you, it actually goes under that heading, goes on to page 171. So you need that. But on page 172, 173 is the review. So the benefits of control systems motivated costs, but some of the costs are tangible and others are intangible. I think I'm going to request. I think I'm going to request that you get pages 71 and 72. They cut you off short, because it is talking about evaluation of control systems, and that need to be completed. 171.
Fraser,
Yes, 172.
you think it's possible we could put in for the 23rd, which would be a Saturday, and we could come and take our exam on a Saturday? If it's possible, I mean, and nobody else mind.
You mean the Saturday after the holiday?
Yes, ma'am, the 23rd, not the 21st, which is Thursday, that's Saturday. Let me look at the date.
Yeah, it's a Saturday. I'm looking at my calendar.
You think that's possible?
I think it is, yes.
Anybody has?
I could confirm with the office,
Please.
as opposed to spending 3 hours on the evening of Thursday.
Only me can do it
Yeah,
on
because
Saturday.
I don't like.
Sorry?
I say only me can do it on Saturday, but I
Yeah.
can do it before. That's fine.
I usually don't like someone doing the exam before everybody else is doing it. I prefer someone doing the exam after everyone is done it.
Okay, well, I could do it on Monday, but I can't do it that Saturday.
That Monday, which is, wait now, hold on. Oh, the Monday would be the 25th. Before I think about it, we have a few more weeks before we confirm, but I will check with BIFs to see if those 2 dates are available. And
Yeah,
then I'd be able to confirm. And so,
yes.
what I'm saying is, we don't have to make a decision tonight, but think about it and let's put it on our radar as we come closer to the next few weeks. Because a lot of things are shifting as we speak.
Yeah, because I think I'm not sure exactly when the next semester is starting.
Yeah. I know they're breaking for the holidays. So there'll be no one in the week of the Good Friday. They might come back the end of that Tuesday. Let me check, because I'm not sure. I'm really not sure. Let me check into it. And I'm thinking by weekend, Monday the latest, I should have your end of term, midterm results. Because I'm going to, they are in my possession. I collected them today, but I haven't started marking them.
On behalf of everybody, go merciful, please. Be merciful.
You're the only, you're the
I
only.
saving my,
I
listen, I saving my mercy for added term, what is 50%?
All I could say is, I feel within myself that you guys did your best. And once you do your best is good enough. I haven't seen anything at all, so I can't make any comment. I just picked them up. I literally just picked them up this afternoon.
All right, then. Well, since you ain't seen none of the fluff yet, that's fine.
To the fluff.
Well, according to somebody, there was not enough space for too much fluff.
Kendrick, that sound like you.
And unless
you could just accuse a brother like that.
unless you ask for more paper. So I don't know. I haven't gotten anything. I haven't gotten any reports from Miss Dean. She just handed over the papers to me and she said, good luck. So I don't know what that means.
Oh, wow.
But what I say about this class all the time is, if you've been doing your reading and you have been attending the sessions, that's a lot of the work already done, because we cover the issues in class and some of you bring up new issues where we could see how it relates to some of the things that we're studying. And so I have every faith that you guys are going to do well. I'll be surprised if you don't.
Oh, wow.
Not putting any pressure on you, but like I said, to get that out from under your belt. The main thing is, and I've always said this, and I will say it again, don't panic. Count to 15 if you have to. Take a deep breath and just rely on some of the work that you've already done. And may the work you've done speak for you. You know that famous song, right? May the work you've done speak for you. And so, but you, and in short order, you should get the results. Any more questions, concerns before we call it a night?
No, I'm good.
Okay. All of you guys can be good, man. This could
Yeah,
be
let's hold hands and let's leave. Let's hold our hands and let's go, y'all.
Okay, good night. We talk soon.
Good night.
Good night.